Good morning, everyone. It is Monday, July 15th, half an hour before the market is going to open. I hope you all had a wonderful and beautiful weekend and are ready for an exciting week ahead. So, the big news over the weekend was assassination attempt on Trump. Sad news. Fortunately, Trump was not hurt, but there were other people in the crowd that were hurt or died. So, hearts out to all of those people who suffered that trauma. It's never a good thing when we resort to violence to try to solve something, especially if it's political. There are a lot of people or a lot of news that is talking about the Trump trade or the Trump assassination trade and all of this. And for me, they're just preying on people and utilizing the news of the moment. So personally, I would not listen to any of that. That doesn't really have a place in investing. And the people that political stuff, maybe there are people who trade politics, but assassination attempts and things like this, not really. And political reasons behind markets, they are really not that influential. I know no one who has lost money by not trading politics, and plenty of people who have lost fortunes by trying to trade politics. So my opinion is just stay away from all of that. It's not necessary, and there are uh, reliable ways for us to make money in the markets. So let's take a look as a fresh slate and see how everything is looking. So I'm going to pretend that I haven't seen anything in the last several months, and I'm just coming back to the markets for the first time. How does everything look? How do I feel about it? How does the market feel? How do the participants feel? And we'll start evaluating the market that way. So we'll start with our dollar, actually. So let's take a look at our DXY. Our dollar broke down below this channel. So it looks like we are moving downwards, a weaker dollar. And weaker dollar means uh, more expensive goods and services relatively. And that is actually good for the markets. So that's one tick for positive markets. If I look at bonds, bonds are chopping sideways. This morning, there's a big trade down or gap down. So looks like we are going to test this purple horizontal line. And if we break through that, then we'll go through down to the top of this channel. And if we go through that, then we'll go into the channel. So I'll cheat a little bit because we are on TLT and we're taking a look at bond yields. And if we go over here to our Fed Watch tool, we do know that there is the Fed actions and at least in this market, priced into the market a strong possibility of a rate cut in September. And in July, it's at 6.7%. We are expecting this to collapse down to zero. We're not expecting a rate cut in July. Right now, the TLT is reacting a little bit more to September. So, in our previous projection that this will come down due to the July rate cut is less strong. It will still come down, but our conviction of how far it might come down is starting to change a little bit. So the bottom of this channel no longer seems possible, but we could still get down into to the top of the channel or maybe into the channel a little bit. So the trade that we have on in TLT is still valid. It's still good. We're just not going to look for a huge movement downwards or as large of a movement downwards as we originally were by the end of July. So, and this September at 94 to 95%, I think the bond market is just overly enthusiastic, and it has been for a year and a half. So it doesn't mean that they'll wake up anytime soon. Is September possible? Yes. At 94, that 94, 95%, it's almost a guarantee. So no, I don't think so. Not even 40%, I would say. I would say maybe 20 to 25% possibility of a rate cut in September. Although things are looking a little bit more favorable in terms of the economic data, but uh, uh, let's finish the rest of our evaluation before we decide on possibilities, especially on rate cut stuff. So TLT looks like it's gapping down this morning. We'll see if that's associated with a movement in the markets, but this will be putting some pressure on the markets because the emphasis of tech in recent weeks. So I cheated a little bit by by having knowledge of what's happening over the last couple of weeks. Before, well, we'll keep on going. Let's take a look at VIX. VIX is low, and we're on the higher range of this low range for 2024. And so if this increases and pops up, then we will start to see a downward movement in the markets. Now, we had the potential of that because of the assassination attempt on Trump, but the market is taking that very well. Trump was not hurt majorly, so the markets did not get too excited about that. And we're just mildly up on the VIX this morning. We'll take a quick look at our CPC. CPC at 0.82, on the lower end of normal, but still normal. So we're not going to read anything into that. Okay, so let's look at our SPY. SPY looking like a very strong uptrend right here. A pullback to the EMA 8 on Thursday, and then a small kind of recovery on Friday. But really, the last 3 days has just been a chop sideways. So this is looking really strong. If I look into RSP, a huge gap up and movement upwards on Thursday, and a big gap up and movement upwards on Friday. So this was in contrast to the S&P. The S&P Thursday was a weekday that pulled everything back to the EMA 8, and the RSP had two very strong days that pulled us to looks like the all-time highs that we're starting to challenge the all-time highs right here. So what does that tell us? That tells us that money moved into a more broad spectrum of stocks. It wasn't just in those large, heavy market cap weighted stocks. So that in general is good news. However, the speed and the magnitude of this move is disconcerting. It smells like that suddenly a few funds probably woke up and said, oh my gosh, I'm short in places that I don't want to be short. And they suddenly covered. And if I look at RSP, or sorry, SPY, we will see that the volume over the last several weeks has been low, but then on Thursday and Friday, we came in a little bit above average. But we need to take that into context because the average here is 48 million. Let's look at this green line right here. You see that sharp drop off and movement downwards. So actually our normal activity is up here in the 70 millions, 80 millions. And the average has dropped dramatically down below 50 million. So I'm not going to get too excited by the fact that on Thursday and Friday, we traded 53 million shares. It's just, yes, we are above the average, but that average has come down so far and so hard that's a little bit less meaningful than it would have been if that, well, not it's significantly less meaningful than it would have been if the average had stayed the same. So overall, RSP, for it to move that sharply and that quickly is looks more like a little bit of short covering and not a long and large sustainable move. So, will this break out? Maybe, but will it break out and keep on running and going? Unlikely. And what that means for the S&P is that the the fact that the RSP went up and the S&P just went sideways, then if the RSP pulls back down, it doesn't mean that the S&P can't keep going up if all the money goes back into the heavy market capital weighted stocks, then yeah, it could still creep upwards, but this market really does need a pullback, a healthy pullback in order for this to move upwards. Let's take a look at QQQ, see if we have the same story. QQQ, sharp movement downwards into the EMA 8 on Thursday, and just a baby movement upward on Friday. This is different than S&P. It just where S&P went sideways, the QQQ came down and stayed down, even though not that much. It's just at the EMA 8, but it's still a different pattern than the S&P 500, and that tells us that those heavy, large market or large market cap weighted stocks, a lot of those were in the QQQ stocks, which are the XLY, the consumer discretionary, and the tech stocks. So is money going to come back into those stocks? Will it stay out of those stocks? Do we get deflated from here? Let's take a look at our QQEW. And that went steadily upwards. So that is actually looking much better. So QQQ is looking stronger and healthier than the SPY, which tells us that maybe we will get that renewed interest, or the interest that was in the tech stocks will continue. So this one is just something that we'll have to watch and see whether it continues to move upwards. But again, the QQQ, after such a large movement upwards, it is going to need at some point a pullback, or at least a mean reversion to the EMA 20, in order for it to reliably and sustainably continue to move upwards. Small caps look just like RSP, except even stronger. Huge movement upwards and gapping up, funds waking up and saying, oh my gosh, I need to be at least not short some of these Russell stocks. So the huge gap up, and again, does not look sustainable. We're not going to, it's very rare that we see a huge gap up like this, run up, another gap up, and then we just say, okay, let's move normally and just do this. That's very rare. This will typically pull back at the very least over here, if not further. And if it's going to go up, then we should see a pullback to this horizontal line before we resume upwards. We might gap up again. We might trade a little bit higher before that happens, but that is what we would expect to happen. It looks like this morning we might be opening near the highs of Friday. So we'll see. Maybe it will go up a little bit more, but at least it doesn't seem like I guess that would be a baby gap, not a huge gap. At least we're not gapping completely above the previous candle. And that is a sign that we might slow down and pull back, or we could just start chopping sideways at a new level other than the one that we have been for the entire 2024. So this is not something that I will get excited or enthusiastic about until it proves to me that it is sustainable, because right now it does not look sustainable at all. What it does look like, though, is that the pullback that we need in this market may not be imminent. It may not be this week. It may not be next week. Whereas when we looked previously, it did look imminent. The fact that we got broad participation in other sectors of the market is making it much more stable and healthier. And we still do need that pullback, and it still does like we are going to pull back, just not necessarily as imminently as we believed. And we might get a little bit of surge of enthusiasm because of the politics and the other weird stuff that is going on right now. And so everything just might be a little bit delayed. So I'll stop there with the broad analysis and not necessarily go straight into deep momentum and the percentage figures because we pretty much already got the story from what we're looking at right now. That anything that we do to look deeper into momentum would just be to confirm what we saw. And I want to focus a little bit more on today. So let's take a look at our futures. And we are positively biased this morning in the futures. The S&P up about 40 basis points, so non-random, 40 to 45 basis points. The Nasdaq up about 40 basis points as well, so just a tad above non-random, and then the Dow up almost 60 basis points. Yeah, almost 60 basis points. So the Dow leading both the S&P and Nasdaq. That's unusual. That's not the usual pattern. So it looks like potentially money is moving into these markets and still continuing to flow in a broader base of sectors, and that is making everything a little bit stronger. The overall markets, the stability of the markets, a little bit stronger. We'll see if this continues throughout the day because typically Monday is a rotational day where people come in and rebalance. They want to see how the market is moving and before they make a decision in terms of what to allocate their money to. So even though this is looking positive, or this morning, you can see that we basically traded completely flat in the pre-market session. So I wouldn't be too surprised if we pull back at the very least to this purple line over here, the 560.2. So just call it 560.2 to 560. If we pull back to that today before we start choosing a direction, could be completely wrong. We could go straight up or we could go sideways for a while, but it looks like a slightly stronger possibility that we will have at least a pullback. So again, if you start seeing it go down, don't get too excited and say, oh, that was a fake out. Maybe not, because we have two very strong levels here for it to bounce off of. And then if it doesn't do that, then we might gravitate towards it later in the day. So I would be careful today. I wouldn't make any huge directional bets today unless there's a very clear bounce off of some level or another. We can add a line right there and a line right here. Okay. So we're opening or right at this purple line right here, but don't be surprised if we chop between this region or if we pull back just one more region down because it's not that, it's 20 cents difference right here. I'm sorry, it's $1.20 difference. It's still, I wouldn't get too excited if we pulled back down to here as well. Two regions is a normal market day. So a little bit biased towards pulling back at least one of these sections before either chopping around or picking a direction up or down. Okay. We were going to take a look at our bonds, and let's take a quick look at our sectors, and then we'll wrap it up. Okay, SMH pulling back to its EMA 8, looking still healthy. It looks actually kind of like the QQQ. XLK, same thing. Silver chopping sideways. QQQ, we already commented on. XLC pulled back to EMA 20, so this is actually looking healthier. If we are just going to have a mean reversion, then XLC being ahead of the game means that it could bounce first. So we're going to look to XLC for clues. If we have a bounce today, then that's positive for QQQ, for XLK, and then positive for the S&P 500. If XLC breaks through and starts to head towards its MA50, then it becomes more likely that QQQ and the SPY will as well. SPY is still looking very strong. We already commented on that. Gold chopping sideways, but challenging the top of this or previous highs right here. So I would wait before getting too enthusiastic about gold. I would want to see that break out and um, and sustain itself. So break out, pull back, bounce up. Then I would be interested in gold. Right now, it doesn't make a lot of sense for gold to run up because the economy is doing well. Gold is a safe haven and it does well when we get bad economic data, but we've been getting good economic data, or at least relatively good, reasonably good economic data. So I'm skeptical of a breakout in gold. Biotech, same thing. Home builders, this is more of an interest rate move, competing against yield, very similar to tech. And home builders, interest rate run up a little too much too fast, just like RSP and IWM. Financials, much healthier, move upwards to challenge highs, but of course, we still have a lot of earnings that are coming out. There's over the next 2 weeks, there's several hundred companies that are reporting their earnings. So I just wait a little bit longer. I want to see an actual breakout in XLF before I get interested in that. Utilities, same thing as the home builders and XBI. This is interest rate driven. Utilities, people buy them for their dividend yields. So it's competing directly against bond yield. So this is a little too much too fast. This is same at biotech. We already talked about it. Healthcare, same thing, a little too much too fast, although looks like we could break out. So healthcare is a sector that I would be interested in watching to see if it breaks out. Industrials, mostly sideways. It did catch a little bit of this excitement, but not nearly as much as RSP or IWM. XLP is completely sideways. Dow Jones starting to get more interest, and you can see how it's kind of going a little parabolic. And now we are matching these highs over here, I believe the all-time highs. And we just want to see how, because it could go parabolic and it could continue to move higher for a few more days or maybe a week, but that would be the end of it. That would come back down. The retail sideways, Russell, we already talked about. Energy is not looking good. That's looking like that downward wedge. And so we're just chopping in between a downward slant and a horizontal line right now. And it's getting pretty narrow over here. So we should have a direction pretty soon, probably in the next week. So that's something that we would just watch. XLB, same as XLI. And bonds, we already talked about. XLY is looking very much like the QQQ. And real estate, this is interest driven also. So really, interest rates are having a huge effect on the market. Tech and the enthusiasm for tech is having a huge effect on the market. We just want to see if that continues or if it peters out, because it does have the potential of petering out. Now that Dow Jones stocks are coming up, IWM is coming up, the RSP is coming up, but it's just too much too fast. So we're going to be skeptical of it until we get actual confirmation, hopefully by the end of this week. But maybe not. Maybe it'll take a little bit longer. In any case, we should know if it pulls back at the very least relatively soon. So before making any big bets and really leaning our portfolio one way or the other, we're going to stay neutral and just watch for see if those interest rate related stocks and the IWM see if they pull back the RSP, see if it pulls back. And we want to watch this week, where does money go, especially with earnings? Does money stay enthusiastic about tech? Because we are going to have the big tech like Google is reporting this week. So we will get a much clearer direction after that. So we'll wrap it up for this morning. Have a wonderful day, and I will see you in the post market session.